Okay, hello and welcome. In this lecture video, we will discuss basic partnership accounting. Okay, so I'm on page 289 here of your course back. And so let's go ahead and get into it. It says organizing a partnership. So partners can invest both assets and liabilities into their partnership. And when they're invested in the partnership, they're recorded at their agreed upon value, which is typically the fair market value. Okay. Asset contributions increase the partner's capital account, and then as we'll see, we'll also talk about withdrawals. Those decrease the capital account. Okay, so let's look at an example where Kayla and Hector start a partnership. Okay, so they organize a partnership called boards, and Kayla's initial investment is $7,000 cash, $33,000 in boarding facilities. And so she is bringing cash, which is one asset, boarding facilities, which is another asset, but then she's also bringing a liability of $10,000. Okay, Perez is just bringing cash. Okay, so let's talk about the journal entry. So on a 111, I'll go ahead and do the journal entry here for Kayla. So with regard to the partnership, right, she's investing partnership and boarding facilities in the partnership. Those are both assets. How do we increase an asset in terms of debits and credits? We debit the asset. So I will debit cash for $7,000 and then debit boarding facilities for $33,000. Okay. Now, if we think back to what we did back in chapter 1 and chapter 2, when we were talking about journal entries for starting a service company, right? And what we did is if we had the owner invest $10,000 in his or her business, we debited cash and then we credited capital. Well, we're going to do the same thing here. Is we're going to credit capital, but we're not going to credit capital for the 7 plus the 33, which would be 40,000, right? Because Kayla is also bringing a liability. So, and that liability is a notes payable. So how do I increase a liability? Credit. So I credit notes payable for my $10,000. And then the credit to capital is for the balance, the 30,000. And when I say balance, I mean the 7 plus 33 minus the 10 gives us the 30. And so I'll be a little bit more specific here. Now, when we have a partnership, each partner is going to have his or her own capital account and his or her own withdrawal account. So we have to make sure this goes to Kayla's capital account right there. Okay. Now, for Hector, he's just bringing cash. Debit cash, $10,000. And then we can credit H. Perez capital for $10,000. Okay. So let's look at Hector right over here. This is basically exactly what we did back in some earlier chapters, chapters 1 and 2, when the owner invested capital in his or her own business to start a business. Debit cash, credit capital. Assets go up, equity goes up because of capital. How do I make an asset go up in terms of debits and credits? Debit. How do I make equity go up in terms of debits and credits? A credit. Okay. Also, some additional points right over here is that I was saying that each partner is going to have his or her own capital account, but then they'll also have a separate withdrawals account. Okay. They'll also have a separate withdrawals account. And just like what we did in chapter 4, remember we did some closing journal entries? Remember what we did? And let's think back about this because we do need to remember this. Back in chapter 4, we were talking about closing journal entries. So we debited revenues and then we credited income summary. Then we debited income summary and credit all of our expense accounts, rent expense, supplies expense, depreciation, so on and so forth. Then what we did is we debited income summary when we had net income, and then we credited capital to move income summary to capital. Remember that third journal entry? We debited income summary and then credited capital. That would be if we have a profit, net income. If we have a loss, then we would debit capital and then credit income summary. But most of the time we were dealing with, they had a good year, so they had a profit. So then we debited income summary and then we credited capital. Okay. And then the fourth journal entry that we did is to move withdrawals to the capital account. We debited capital and then we credited withdrawals. And that's what I'm talking about right over here. And again, we have separate capital accounts and separate withdrawals accounts for each partner. Okay. So now let's talk about dividing income and losses. So dividing profits and losses among the partners. That's what we want to talk about now. Okay. So there's a couple different ways that the partnership could do this. And this would be specified in the partnership agreement. Okay. It'd be specified in their partnership agreement. So there's three different ways that we'll talk about. Could do it on a stated ratio basis. So the partnership agreement just says that Kayla, for example, gets 2/3 of income or losses and Perez gets 1/3. We could do it based upon their capital balances, or we could do it based upon services, capital, and stated ratios. So let's look at this first one, stated ratio. Okay, so allocation on stated ratio. And we look at our example right here. It says in the partnership agreement, Kayla receives 2/3 and Perez receives 1/3 of partnership income or loss. If the partnership income is $60,000. So remember when I was just talking about our closing journal entries? Remember what I said is we had our income summary. Our first journal entry for closing was to debit revenues and then credit income summary. The second journal entry was to close out our expense accounts. We debited income summary and then we credited all depreciation, rent, supplies, all of those expense accounts. So we're saying over here is partnership income is $60,000. That means our revenues in income summary exceed our expenses in income summary by $60,000. So what I'm saying is if I look at a T account over here for income summary, I have a credit balance of $60,000. That's what this is telling you. Okay, that's another way to think about it. So I have this credit balance here in income summary. And if we think back to the closing journal entries that we talked about back in chapter 4, what we have to do is close this balance in income summary to capital. So do you remember that journal entry? Think about it. If you said debit income summary and then credit capital, you're right. But in this case, we have two capital accounts, Kayla and then Perez, because we have two partners. And remember, those partners each have their own capital account. Okay? How do we split up the $60,000? Right here. 1/3 goes to Hector and 2/3 goes to Kayla. Okay? So on 12/31, I will do my closing journal entry. This is my closing journal entry to allocate out the partnership income to the capital accounts, just like what we did back in chapter 4. Same idea. Okay? So I will, if I want to zero out income summary, what I need to do is put that there. I'll come down here and write the journal entry. So we will debit income summary for $60,000. And then 2/3 of that $60,000 goes to Kayla, 1/3 goes to Hector. So I'll come over here and multiply 2/3 times the $60,000, K, Zon, capital. 2/3 times the $60,000 is $40,000. And then that means Hector gets $20,000. All right. And then it's moved to the capital accounts. So very similar to chapter 4. This is like what I was saying. I've said several times during these lecture videos that if you understand the fundamentals in those first 4 chapters, everything else just should make sense. So look, this is the exact same thing that we did back in chapter 4. It's just that we have multiple capital accounts, one for each partner. Okay, so that's the allocation based upon the stated ratio basis. Let's talk about based upon their ratio of capital balances. That's the next one that we can look at. So this will assign income and losses based upon the ratio of each partner's relative capital balance. Okay, so it says in their partnership agreement, okay, Kayla and Hector agreed to allocate profits and losses on the basis of their beginning capital balances, so the beginning of the accounting period. Okay, Kayla has a beginning capital balance of $30,000, which we saw, right? Remember, we did that journal entry to establish their partnership, and we credited Kayla's capital for $30,000, and we credited Hector's for $10,000. So that means total capital is $40,000, right? And then income is $60,000. So that means that Kayla gets $30,000. She has $30,000 of that $40,000 total capital, right? The $30,000 plus the $10,000. So that means she gets 3/4 of income or loss. And then that means, of course, Hector gets 1/4. Okay? So I can multiply my 60,000 times my 3/4. Well, remember, I'll debit income summary for my 60,000, and then I will credit Kazon capital for 3/4 of that 60,000, which is our 45,000. And then I will credit H Perez for 1/4, which is 15,000. The journal entry is the same. It's just debit income summary, credit capital. But the dollar amounts change based upon how they allocate it. Okay? And then again, these are 3 different potential ways that it could be allocated, and that would be specified in the partnership agreement. We could do it based upon their capital balances, based upon a stated ratio, or as we'll see now, a combination of the 3. So now what it can say is allocation based upon services, capital, and stated ratios. Okay? This is a more complex way, but it recognizes that service and capital contributions of partners are not always the same. You can say some salary allowances can make up for those differences in service contributions, how hard the partner is working within the partnership. That'd be the idea of service. Okay. We can also have interest allowances can compensate for unequal capital contributions, and the way we'd figure that out is our percentage allowances multiplied by the beginning capital. Okay. And so our allocation of share and loss can include both salary and interest allowances. So let's look at our example right over here. Kayla and Hector have a partnership agreement with the following conditions. Kayla receives a $36,000 annual salary allowance, and Hector receives an allowance of $24,000. Each partner is allowed an annual interest allowance of 10% on their beginning capital balance. Okay, on their beginning capital balance. Okay, any remaining balance of income is allocated equally. Okay, and then note that these salaries are not expenses on their income statement. It's just a way, so we wouldn't see salaries expense on the income statement. Okay, because they're owners and they're assumed to work for capital. Okay, for generating capital. So these are not salaries expenses. It's just a way to allocate income to each partner. Okay. So I think what I'm going to do now is I'm going to stop this lecture video, and then I'm going to pick up on the next lecture video to talk about 2 different situations where net income exceeds the allowance. So let's assume net income of $70,000. And then let's look at a different situation on the next page where net income is only $50,000, which is less than the total allowances. Okay. So we'll look at those 2 situations starting in the next lecture video. All right. Thanks so much.